Alright friends, Super 50 question number 4. Alright, so here I'll write down working note number 1, basic data. Alright, let us read through this question now. A US based company is planning to set up a subsidiary company in the view of its growing demand for its product and competition from other US based companies. The initial project cost consists of plant and machinery having the investment of $490 million. $490 million. The net working capital is how much? $60 million. $60 million. Company is following straight line method of depreciation. So SLM method of depreciation. Currently, the company is exporting 2 million units every year. Every year at a unit price of $90. $90. Variable cost is how much? $50. Alright. CFO of the company has estimated the following operating costs and the other data in respect of the proposed project. Variable cost is how much? Now this was the cost in US. We have to understand that. As of now, what is the company doing? Company is exporting. So this is the cost happening in US. I think we need to have a clarity on how the question is going. I'll just take a fresh page. There is a US based company. Okay. Currently, what is the US based company doing? It is exporting to India. How many units it's exporting to India? 2 million units at $90 minus I think $50, right? Correct. Okay. So they are making $40 into 2 million. How much is that? I think that's somewhere around 800 lakhs or something like that. We'll just stick to that amount. That is their profit as of now. Now what are they doing? Now planning to open a branch in India. So what happens the moment they open the branch in India? What will happen? Okay, exports will stop. Okay, everything will be sold locally in India. I hope you are clear with this concept, friends. I'll give you a 10 seconds time. Read through this entire thing. Very, very crucial. If you have any doubts here, I'll clarify that for you. All right. So let me continue now. Okay. So we have reached here. I'll just go to point number G, E, F, G. Okay. So we have put variable cost. We have put selling price also. And now we will put point number G. Let's come down. Variable operating cost is how much? $30 per unit. Variable cost in India. Is equal to $30 per unit. All right. Additional fixed cost is $30 million. $30 million. Okay. And projects allocated fixed cost is how much? $3 million. To $3 million based on the ability. Life is how many years? 5 years. What about the salvage value? That turns out to be 0. Okay. Let me go to the next part now. Salvage value is 0. And then you have production capacity of the proposed project in India will be 5 million units. Capacity in India is going to be 5 million, friends. So they can sell a lot more in India. We are assuming that there is a lot of demand. Existing working capital for the production and sale of 2 million units through export was $25 million. So this $25 million will now be saved. Dollar will not be needed once we open branch in India. So this will be a savings for us. Are you all clear with this part? Now they have given a beautiful sentence. Exports of the company will decrease to 1.5 if they don't set up a subsidiary in India. Alright, so that part is a little tricky. I'll just explain that to you. I'll write N. If export is not done to India, unit sales will come down to how much? 1.5 million units. Everyone interact with me. As of now, they are exporting how many units to India? As of now, they are exporting 2 million units to India. Correct? Now, once this, if they don't set up a branch in India, that will come down to how much? 1.5 million units. Or what is the interpretation of this is that if they open a branch in India, then they can sell 5 million units. That is what we found out over here. See. Okay. However, 1.5 million units will anyways be lost. Will be lost, which is an opportunity cost. So this will actually become nothing but an opportunity cost for the company. Alright, this sentence is very crucial. Friends, when you get a question like this, basic data is very, very crucial. Write down properly, understand properly. Once you have a grip on the basic data, remaining parts become very, very easy for all of you. Okay, so now I'll just come over here. I think we are done with the basic data almost. We have some more information. Tax rate. I think it is 35%. Required rate is equal to 12%. Alright. So this is the entire details that are given. Let's just take a minute and let's just read through the entire thing now, friends. Okay. Now, this being a capital budgeting question, we will basically have three types of cash flows. One is initial, second one is in between, and the last one is terminal cash flow. So what we'll do is initial cash flow, we'll call it as I. In between cash flow, I'll call it as B. Terminal cash flow, we'll call it as T. I hope you understood. I means what? Initial. This is in between and this one is terminal. Now, read through it one by one. First one is what? Tell me. I. Second one is what? I. SLM method of depreciation will come as what? In between cash flow. Okay, current demand of 2 million units, relevant or not relevant? I'll call not relevant as NR. Okay, not relevant because it has come down to how much now? It has come down to 1.5 right now. These two things are also relevant in what? In between cash flow, but with 1.5 million units, not with 2 million units. Are you clear? So earlier they was getting a contribution. Now they will not get it. That becomes an opportunity cost. Okay, Shiv Soundarya, you want me to explain to you adjustment number 6. You mean what is adjustment number 6? You mean the variable cost F? Or you mean this one? I am coming to that. I am coming to that part. Okay, I am coming to that part. Okay. Now tell me, what about this $30 per unit? This is also in between cash flow, correct? Additional fixed cost. This is also in between cash flow. What about allocated fixed cost? Relevant or not relevant? This one is not relevant, friends. Life of 5 years, in between. Salvage values for depreciation, in between. 5 million, in between. What about this $25 million? This is not terminal, this is initial. And the beginning itself, what will happen? The moment we invest $60 million in India, 25 million will be recouped. Everybody clear with this part? Okay. Munshir, allocated fixed cost can be of two types. It is a committed cost exclusively for the project or a common cost which has got allocated. If it is a common cost which is getting allocated, we will not consider it for the in-between cash flow. Are you all clear with this part now? Okay. So I think we have put up all the points here. Now we'll recall this US based company exporting to India. Now this $2 million is not relevant. Okay. This is coming as in between cash flow. All right. The moment you do this, what will happen? Export will stop. Earlier, how much was the export? 2 million. Now the export has come down to how much? 1.5 million. If Indian branch not opened, correct? Are you clear? Now I'll tell you what when I come over here. Now read through this part carefully. If export is not done, sales will come down to how much? 1.5. Now since the branch has been opened in India, they will sell 5 million in India, but this 1.5 million sales will be lost because no more exporting. But yeah, overall what is happening? Your sales is turning out to be 3.5 million. India you are selling how much? 5. Here you could have sold only 1.5. So extra 3.5 is your profit. You can take it like that also. But the difference is on this 1.5, your cost will be 90 minus 50. Okay. Whereas in India for 5 million, okay, this is US export. Whereas in India, you are selling 5 million units, okay, and you are going to get 90 minus 30. So you have higher profit in India. Cost is coming down. Did you follow this part also, friends? Fine, perfect. So if you are clear with this, now I'll write down the next working note. Initial cash flow. Okay. So now let us take the initial cash flow. How much is the investment that you have? I think you got the number as 490. Okay. $490 million. Okay. Additional working capital. How much will be the working capital now? 60 they have told, but 25 they will release in US. Correct? So the net effect will be how much? $35 million. What will be your total initial cash flow? Do you get the, 490 plus 35. Do I get the answer as $525 million? Okay. Now I'll write down working note number 2. In between cash flow. Alright. In between cash flow, I'll write down Roman number 1 in India. Because in US we are going to make a loss of 1.5 million. Correct. So first I'll write down contribution. So everyone tell me how will I work out the contribution? 5 million units into what? $90 minus $30. That is $300 million will be your contribution. Minus how much is the fixed cost that we have already frozen over here? I think it is 30 lakhs, $30 million. Apart from this, we will also have depreciation now. That is 490. Life is 5 years, correct? I'll get the number as $98 million. I think that's it. From this, I can find out my profit before tax. Right? How much will that turn out to be? Do I get the answer as 172? On this I will have tax. How much is the tax rate? They have told 35%, right? 60.2. So from this I can find out what? I can find out the profit after tax. Okay. Now here what I'll do? This plus I will add back depreciation because that's a non-cash item. Am I right? So 131.8 plus what is the depreciation that you are adding? You get the number as 229.80 million dollar. Are you all clear with this part now? Okay. So once I get, hold on. I think there is some calculation mistake that I have done. I have done a calculation mistake, friends. Thank you for correcting me. It will be 111.8. 111.8. This is going to be my PAT, correct? So what is going to be when I add depreciation? How much will be the amount that I'll get? Plus 98 will give you the answer as 209.8. This is the money that I'm going to make in India. Now I have to write down Roman number 2 and find out what is the money I lose in US. Okay. Roman number 2. Opportunity cost in US. There I'll write down point number A. How much is the contribution that we found out? 1.5 million into how many? What was the sale value there? 90 minus 50. Do you get the answer as $60 million as the amount? Am I right? Correct. On this, what will happen? I'll be getting a tax. We are assuming the tax rate is going to be the same. So once I reduce this, what will be my profit after tax over there? I think I'll get the number as $39 million. Now this $39 million will become my opportunity cost. Alright. So then I'll write down Roman number 3. Net cash flow. Alright. So everyone tell me what is the net cash flow? $209.8 million minus 39. Do I get the answer as $170.8 million, friends? This becomes my in-between cash flow. Alright. So friends, I have done with initial. I have done with in-between. Now I'll just write down the final working note. I'll put it here itself. Terminal cash flow. Can you tell me what will be the terminal cash flow over here, friends? Here the terminal cash flow will be the working capital which will be recaptured. How much will I get back now? $35 million. After 5 years, I'll get that money back. Correct? So based on this, now I'll write down the final working note heading NPV. Here, cash flow, discount factor, discounted cash flow. Year 0, how much are we paying? 525. Year 1 to 5, how much are we getting back? 170.8. At the end of year 5, how much is my salvage value? 35. What is the discount factor they have told in the question? 12%. So shall we do it now? Here I'll get 1. Just confirm, is it 2.71 the PV factor? Just confirm that, okay? Is it 3.60? Yeah, I think there was a mistake here. Correct. This will be 3.60. Correct. So I'll get 614.88. Do you get the answer as 109.725 as the answer over here? This NPV is positive, hence what are we supposed to do? Hence, we are supposed to accept the project. Alright. Rajesh, 60 is not the terminal cash flow because 35 is what is getting blocked today. So at the end of 5 year only 35 will get released. If today 60 was getting blocked, at the end of 5 year I will get back 60. Are you clear with that part now? Okay. So friends, we are done with this question also.